Good afternoon, everyone, and welcome to Prestige Wealth Management Group's fourth quarter 2023 economic and financial markets update. On today's webcast, you're going to hear from Prestige Wealth Management CEO, Roy Williams, Senior Portfolio Manager, Paul Esposito, and Wealth Advisor, John D'Angelo. Just a couple housekeeping items. Please note that this webcast is being recorded, so you will be able to receive a recording back after the webcast is through. And please note that we cannot take any live questions during today's webcast, but if you do have any questions, please send them into pwm@prestigewmg.com, and we'll be sure to get back to you. With that, I'll pass it over to Paul Esposito to get us started.
Michael, thank you very much. We're going to first discuss, the state of the state with the economy, and then, of course, Roy and John are going to talk more in depth about where we stand with the Fed, and of course, what impact it's going to have on fixed income and equity markets, what impact it's had, and what we anticipate for the remainder of 2024. So if we look at GDP, final quarter of 2023 showed an impressive recovery in both stocks and bonds, thanks to the Fed signaling that rate cuts were on the horizon. It seems that the Fed is certainly more comfortable with the level of inflation, and the prospects of a soft economic landing are more imminent now. Many participants have been perplexed as to how resilient the U.S. economic growth has been, despite one of the fastest hiking cycles on record for the Fed. This is certainly evident when you look at real GDP trend for Q4, which posted a 3.1% year-over-year growth rate. Inflation cooling off in the second half has certainly helped with the consumption component of GDP, as you could see to the right hand chart, which is the largest driver of U.S. economic growth in the GDP function. At present, Q1 GDP for this year is expected to come in right around 3.4%, and that's based on the Atlanta Fed's outlook. And although that figure could very well be revised down, just the initial run of corporate earnings that we've seen in the last few weeks is very supportive of that GDP trend continuing. January's unemployment print of 3.7% is consistent with where it stood for the fourth quarter, while wage growth maintained a 4.8% growth level, again above the 50-year average, which is certainly compelling. This trend is very supportive of the consumer, and primarily the reason why we have managed to avoid a technical recession. If you go back to 2022, and some of the growth concerns that we had, with wage growth well above the unemployment rate, I would not really begin to worry about the prospects of a traditional cyclical slowdown, really until wage growth and the rate of unemployment start to meet each other, as really it's the decline in wages and the concurrent rise in the trend in unemployment that tend to coincide with a typical recession or the onset of a typical recession. So right now, based upon those two metrics, the economy seems to be on board for the prospects of the softer economic landing. Job openings, on the other hand, have declined from the March 2022 peak. However, they're still at a level well above the prior pre-pandemic peak. A lot of companies in growth-oriented industries were certainly guilty of increasing job openings for future demand that did not necessarily come to fruition. I think you saw a lot of that in the tech space. So if you go back to 2020, 2021, many tech companies ramped up positions, but recently started to pare them back. But regardless, the labor market is still tight by this metric. Layoffs, on the other hand, the right-hand chart, have crept up a bit, but are still well below the pre-pandemic levels. And the reasoning for this is that the rapid retirement rate of the baby boomer population is really why the trend could stay in place for some time. Inflation, which has been the bane of the Fed's existence from their call back in 21 and of transients to them admitting that they were completely at fault in 22, and of course accelerating their the fastest rate hike cycle on history. Inflation has come down a lot within the last year, really across the globe. U.S. CPI is still hinged at 3.4%, which is modestly above Europe and our Japanese counterparts. The decline in energy and material prices has certainly helped with the headline figure. But if we look at the target inflation rate, the Fed's target inflation rate for various countries, and the metric they use is a core personal consumption expense, or core PCE. That's actually come down a lot since the June reading. I think the last time we had this dashboard up, we were running at 3.8%, or 1.8% above the Fed's 2% target. And if you compare to where it stands as of February of this year, we're now running at 0.6% above the Fed target. So given that the actual core PCE is much closer to the Fed's targeted 2%, it justifies why the Fed has really, telegraphed they're done hiking rates, and really why the market is now starting to entertain at least 3 to 4 rate cuts in 2024. The decline in both inflation metrics coupled with consistent wage growth is, again, very supportive of the consumer and sustained economic growth. The housing component of inflation has, still been sticky. Median single-family home prices have declined nationally by 5%. However, when we look at the existing home prices, they haven't really budged, and they're very close to their prior peak. High interest rates have certainly affected many of the home builders and their ability to provide incentive financing for new construction. So that maybe is explaining why the new single-family home sale prices have come in. But there's still a very tight supply of homes on the market, which is essentially keeping prices at bay for the present. Housing inflation continues to be the nemesis of the Fed in combating overall inflation. But given the dynamics of tight labor supply, tight supply in the housing market, it could very well take some time for prices to moderate. And we talk about this all the time. What is the cure? Do we necessarily need to see a retrenchment in housing prices, 5, 10, 15%, like we did in the post 2008, 2009 housing slowdown in order for this to manifest? And it very likely it could just be a function of prices plateauing and don't necessarily go down for an extended period of time. That really could be the solve, because again, the supply is at record, at a multi-decade low here in the housing sector. Consumer sentiment tends to be a very good gauge for future market growth. That's when we see consumer sentiment readings, start to go higher from prior troughs. So, rising levels from previous lows tend to bode well as a leading indicator for market prices, mostly on the equity side. All of the consumer sentiment readings that we see here have trended higher for the quarter. Declining inflation, the record low unemployment, wage increases, and the large move that we saw in both stock and bond prices from November into December all contributed to this. Despite the upward trend, sentiment readings are still just modestly above the 2020 pandemic levels that were met. If you look at the 2022 readings, they were all pretty close to the financial crisis lows of 2008, 2009, and again, very close to 2011 when the U.S. economy was at risk for another recession. That's, of course, when we had our credit rating cut from AAA. So with inflation at record levels, then it's at current record levels, then it's really hard to believe otherwise. But again, I think it's a testament to the stronger labor market and wage growth overcoming that inflation. Even if you go back to the two recessions in the early 80s in this chart, you had higher sustained inflation and a Fed that was effectively trying to, ward off that inflation. But unfortunately, you had higher unemployment levels. So provided that inflation is brought under control this year and that the labor market stays strong, we very well could continue to see an improvement in these readings. And hopefully that, that'll portend to, better price movement in the equity markets. And with that, I'm going to hand things off to John, to Roy.
Roy. Yeah, when we look at the Fed and interest rates, it's really interesting. When you look at where we were in September, October, you had the stock market deteriorating, you had the bond market deteriorating. At that point in October, the aggregate bond market was down almost 3%. And by year end, finished up approximately 6%. To have a 9% swing in a quarter, I've been doing this for over 40 years. Seems like yesterday, but over 40 years. And I've never seen a quarterly swing in the bond market like that. And as Paul stated, it had everything to do with inflation, coming in and the Fed changing their policy. What I tell, as Paul said, we expect 3 to 4 rate reductions this year. And also the Fed normally, it was an election year, wants to be accommodating and not impact the election. But, there's always risk. And as we didn't expect a 9% rally in the last quarter, there are always risks in bond market, stock market. So, what we're looking at right here, a lot of people want to be in short-term interest accounts. You have money market accounts paying 5%, a little more than 5%. You have short-term treasuries paying a little more than 5%. But my recommendation and the team's recommendation, look at 5-year paper, look at 7-year paper, lock in some of your money using a laddered approach and lock in some of the money longer term, because when the Fed starts decreasing rates, you're going to see a deterioration in those bond prices. So again, just any questions, or if you have money not earning a decent rate of return in your money market account, please give myself, Michael, John, or Paul a call, and we can definitely get you a lot better rates. With that, I'm going to have John talk about the stock market valuations.
Thanks, Roy. This is a bit of a different chart than we've used in the past, just to measure where valuation is. It's a little bit more of a historical look at forward PE multiples over time. Right now, we're looking at a PE ratio of about 20.2, which I think historically is a little bit on the higher side. And I think that it can really be attributed to the premium that's being paid for artificial intelligence and machine learning and these very large companies that maybe some clients have heard about, the Magnificent Seven companies, which dominate the market cap of the index. And right now you're paying an equity premium, a fairly substantial equity premium for that matter, for those particular companies. So we've got a bit of a bifurcated market from a valuation perspective, which historically, if we think about that, back in 2020, we've seen this story a few times. From a pandemic perspective, we saw these large cap technology or large growth companies move higher in a spectacular fashion. We had a bit of a rotation once once we had what they called, I guess, the reopening trade, where the economies were reopening, we saw this rotation from some of these large growth companies into some more what we call value stocks, or some companies that were going to benefit from the reopening. For example, airlines and travel companies and such. And then what we've seen at least in 2023, last year, was we saw starting in the first quarter this movement into a lot of these companies based on forward earnings and forward revenue projections for artificial intelligence, and those companies really carried a pretty large percentage of an outsized return that we had last year. But if we think about it from a growth versus value, value stocks are very reasonably priced in retrospect. In some cases, they're exhibiting close to recession level valuations. And that may speak to, and we might talk a little bit about this as we go through the slides, is that did we have rolling recessions as opposed to an actual technical recession, and are we now coming into a period of expansion again? And we'll have to see. So with that, I'm gonna pass it back over to Roy. Talk a little bit about growth versus value.
Yeah, and as John was saying, I mean, growth stocks, are expensive, but just pointing you to history, they could stay expensive for a long time. I remember in 1998, they were expensive. And then we had 99, they got more expensive. And we had the first quarter of 2000. So we had another 15 months of a rally in growth stocks. So it's very difficult to predict, when the rotation happens. And again, we do have growth and value in the portfolio, and we are overweighted growth now. And you may see some changes in the portfolio where we move a little more towards value. And value stocks are healthcare stocks, financial stocks, companies that will benefit from an accommodating Fed decreasing rates this coming year. Consumer staples and companies like that are value stocks. So but this, as John was saying, the valuations in value stocks are historically and relatively favorable. But again, the growth trade can, as it did in 99, early 2000, it can continue. So that's why we believe in having diversification, and you really can't time the market no matter how good you are. And next we'll have John talk about, the various market capitalizations.
Thanks, Roy. Yeah, and I think this is a continuation of the story from the last slide. And to your point, yeah, I mean, artificial intelligence, machine learning, it's a new emerging industry, and it's hard to say how long. Back in the 1990s, I think both me and Roy remember Greenspan talking about irrational exuberance, and that could last for a very long time. And if you look at this chart, speaking about large cap versus mid and small cap, this again is an indicator of these large growth stocks and their outsized returns that they've had, for probably, I'd say, two reasons, right? So we've talked a little bit about the artificial intelligence and the machine learning aspect, but there's also this Fed pivot. We think back to November of last year, where the Fed really started to position. This is their first time that they started to position that they may be pivoting from a tightening supply from a money perspective to a looser policy, or at least indicating that they were going to be rate neutral. And what we saw the equity markets in fourth quarter of last year rally and rally fairly significantly on that news. And I think that also helped to add, I'd say, a little bit of more fuel to the jetpacks of these large growth companies, and their fourth quarter returns were ahead of market. Now, look, I mean, we're going to probably continue to be overweight large cap and growth, but every year we do a rebalancing. Probably over the next few weeks, Paul will be running a rebalancer through some accounts, where we'll be trimming things that have had the more outsized returns, and then rebalancing into positions that may be a little bit underweight. So we'll probably be profit taking a little bit, at least later, potentially this month. And with that, I'll pass it back over to Roy.
Yeah, it's important when we talk about fixed income, believe it or not, there's still market volatility. What can cause market volatility in a year where the Fed's going to most likely decrease rates 3 to 4 times? You have a war going on in the Middle East. You have a shipping channel that is being, shipping container ships are being attacked. And we're trying to defend that. And you have some shipping companies saying that they're going to go the long way around, which now delays distribution. Thankfully, supply chain and all that has mostly fixed itself and righted itself. But, again, if you have a supply chain issue because of what's going on in the Middle East, that can impact fixed income returns on a short term. And it's important to look at, we can have volatility, even though if you look at some of these years, the bond index was down. There's only been 5 years out of 48 years where they ended up down for the year, even though there's a lot more years where they were down during the year. So we're optimistic this year because once the Fed has their first rate hike, first rate reduction, we believe there'll be a very nice rally in bonds, and bonds will end up having a good year. But don't be surprised if we still have volatility in bonds this year, in spite of us being opportunistic and very favorably inclined towards bonds, having a positive year. John, you want to finish it up with what happens to the markets after the rate hikes?
Sure. I think the chart is very self-explanatory. Once you get past that last Fed rate hike, historically, you're usually seeing mostly positive returns. And there's good reasons for that. Lower interest rates, they promote growth, corporate growth. And, if companies are growing and companies are earning more money, their stock price is going to follow. And rate cuts are certainly indicative of creating an environment that's a benefit for, both fixed income and for equities. Now, look, the outlier there is certainly 99 and 2000, which is, the tech wreck. And there are, to Roy's point, plenty of risks out in the future. So there's no guarantee that we're going to see positive returns, even though historically, we'd say the percentages statistically are in favor of better returns for the stock market. But there are things to be concerned about, and that as an investment policy committee, we'll continue to monitor and discuss the geopolitical issues. Obviously, there's wars across Europe and the Middle East. And we have a year coming up in a couple of years out yet, but where we may be looking at potentially higher taxes. So we'll be monitoring those things during the course of the year, and as always, we'll make adjustments to the portfolios accordingly. So.
All right. And with that, we want to thank everyone for joining us this afternoon. Just as a reminder, everyone will receive a recording of this afternoon's webcast. And if you do have any questions, please email us at pwm@prestigewmg.com. And again, thank you guys for joining us.